Hey there, Singaporean investors. If you're keenly interested in DBS Group Holdings, DO5, and you're wondering whether to buy more, hold, or even consider selling right now, you're in the right place. I'm Iggy from the Investing Iguana, and in this video, I'll give you a candid, balanced breakdown. 3 compelling good points that make DBS attractive, and 3 important red flags you must watch. Stay till the end for my personal verdict on whether to buy, sell, or hold, plus how I position in the current rate cycle. The Investing Iguana was ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed 1 million reads and 58,000 likes, and I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also track regional and global macro, so you get the broader context. If you want to spot both hidden gems and pitfalls on SGX, this is for you. Let's start with the positives. For DBS, one of the most compelling strengths is its fee engine and wealth franchise in a resilient core market. Think about it. In Singapore, stability plus scale often translates to steady compounding, especially for CPF/SRS sleeves. DBS's wealth and cards fees have grown well in H1 2025, while total income held up even as net interest margins eased. That's like a wide moat with multiple bridges inside. If one path narrows, rates fall, the other paths, fees, treasury, trading, keep traffic flowing. Results show fee income hitting multi-year highs alongside record first-half income, which points to durable demand from affluent clients and strong digital distribution. This dominant position is a foundation. The key is whether fee growth can keep outpacing NIM compression. Second good point, a robust dividend stream backed by high ROE and strong capital. For many Singapore investors, passive income matters. DBS pays quarterly dividends, with 75 cents per share per quarter in 2025 so far, 60 cents ordinary plus 15 cents capital return. That's a run rate yield near 5% at current prices. It reflects solid earnings power and prudent capital management. The bank's CET1 ratio sits around 17%, with liquidity buffers well above regulatory minimums. In plain words, the cash engine is reliable, and the fuel tank is full. For CPF/SRS, that regular cadence and scale can anchor the income sleeve while you manage risk elsewhere. Third positive, asset quality remains resilient despite a softer macro. NPLs hover around 1.0% with strong coverage. Specific allowances stay low. Loans and deposits both grew in H1, showing steady customer activity. This matters because credit costs can swing earnings more than margins in downturns. DBS's diversified book and Singapore's macroprudential backdrop help keep the credit curve smooth. It's not exciting, but boring can be beautiful when you want compounding plus sleep-at-night risk. Now the flip side, 3 red flags to watch before you make any moves. First concern, net interest margin pressure is not done. Group NIM slipped to roughly 2.05% in Q2 2025, and the commercial book margin fell more. With the Fed cutting and SORA easing, asset yields reset lower while deposit costs can stay sticky. Each 25 BPS cut can shave earnings. If NIM dips below 2% for more than a quarter, expect estimate downgrades unless fee growth and volumes pick up. This is the headwind that keeps valuation honest. Second red flag, premium valuation needs near-flawless execution. DBS trades around 1.8 to 1.9x PB and low teens PE, a solid premium to OCBC and UOB. Management said 2025 net profit will be below 2024 due to the global minimum tax, even with healthy income trends. If fees cool or NIM compresses faster, that premium can mean a sharper pullback. Watch ROE. If it drifts toward 15% and stays there, multiples can compress toward peer ranges. Third issue, regional growth and trade friction. Singapore is tightly linked to global trade. Tariff uncertainty and slower China growth can delay corporate capex, soften trade finance, and reduce wealth transaction activity. If PMIs hover below 50 and export prints weaken, banks feel it. That's not a DBS problem alone, it's a system effect. But size does not fully shield activity-driven earnings. For even more granular data, in-depth charts, and a full written breakdown of DBS's financials and strategy, check our Substack. The link is in the description. We weigh DBS's fee strength and wealth franchise, the dividend and ROE profile, and the resilient asset quality. We also face the challenges: NIM pressure, premium valuation, and regional headwinds. My overall assessment: hold. The franchise is world-class and execution is strong, but the stock already embeds a lot of that quality. With rates drifting down and profit guided below 2024 due to tax, I don't see a clear enough margin of safety for a strong buy at current levels. At the same time, the bank's strengths and payout discipline do not justify a sell. Strategy for Singapore investors: if you already own DBS, holding makes sense if you're long-term and comfortable with the rate and macro risks. The quarterly dividend helps you wait. If you're looking to start or add, I'd be patient. Look for signs of NEM stabilization around 2.0% or better, or buy on pullbacks into the 47 to 49 zone. For CPF/SRS, DBS can fit the income sleeve if your horizon is long and you can stomach near-term swings. We've broken down DBS's strengths and weaknesses, and I've given you my verdict and strategy. If you found this useful, please like the video, share it with SG investors, and subscribe to the Investing Iguana so you don't miss future deep dives. Premium members get early access to all videos, often a week ahead. You'll receive my detailed analyses and urgent signals before the crowd for just $3 a month, the price of a coffee. Think of it as your daily dose of financial fuel. Ready to join the inner circle and get that early edge? Click the link in the description.